You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it is time once again for a little program I like to call around these parts the Advisor's Option, the program for you, the busy financial advisor and asset manager who's out there trying to learn how to implement these products into your clients' portfolios. Maybe you're also said client, and maybe you want to learn, what should my advisor, what should he be up to? What should he really be doing from an options perspective? Either way, we got you covered. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-exciting Options Insider Radio Network. A lot of great stuff hitting it this week, so enjoy that. Stay tuned. Lots of fun stuff there. And stay tuned for my great cohorts, my cavalcade of stars joining me on the Advisor's Options program. First off, let's go all the way out to the middle, not quite the middle, but into the Atlantic, to a little island known as Puerto Rico, where we are joined once again. You know him, you love him. He is the Director of Risk, a.k.a. Mr. Chris Hausman from SWAN Global Investments. Mr. Risk Director, welcome back to the program, sir.
Mark, good to have me on again, and I survived the political unrest that we had here recently, so all good, moving on.
Yes, good to survive such things, I find. Better than the alternative, much better. And also joining us, I don't think there's really ever any political unrest up there. It's a very happy, very tranquil place. Of course, I'm talking about New Hampshire, the other options mecca of New England, outside of Andrew and doing all of his options searching in Maine. Number 2 in New England, of course, is New Hampshire. And that's because of this guy, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the program. It has been too long, so we have to stop meeting in such fine locations as we did last week, sir.
All right. It's great to be here. It felt like a podcast, and we saw each other in Chicago, so it's great to be on. I'm glad Chris survived down in Puerto Rico. It feels like Puerto Rico here in New Hampshire. It's beautiful out. Happy to be here. Let's get this thing going.
Let's do it then. Let's kick it off with a little bit of the old buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we kind of catch you up on what's going on in the world of options, what's been kind of occurring, and in the market, of course, since our last show. And a lot has been going on. We're kind of heading into, as we're recording this, it's the tail end of July. We're starting to head into the dog days of summer here. Not a traditionally hot time in the old markets, so we're going to make sure, take advantage of the opportunity to get a bunch of you folks rotated onto the program this week with a little bit of the old office hours summertime extravaganza. But before we do that, I want to kind of catch up on what's been going on in the marketplace. We, of course, are right in the teeth of earnings season again. We're in a period where, this trade war, will they, won't they dance is kind of leaning towards markets looking pretty good again. Markets rallying. We have, of course, Fed on the horizon here this week. Everyone pricing in predominantly a 25 basis point cut, even though there are somewhere around 20 to 25%. At least last time I checked on the FedWatch tool was pricing in a little bit more aggressive, somewhere around 50 basis points. So we shall see on that front as well. But let's start the way we went. Let's start with the Director of Risk. Sir, when you were not busy dodging political unrest, there was, of course, some interesting times in the market. We're seeing kind of now more of that, I guess you can call it that languid summertime upside follow today off a little bit, but in general, the markets have been trending mostly upward with a bit of that vol coming in a little bit again. What's it been like over there for the Director of Risk over the last month or so? What's been going on as you manage the DRS, sir?
Well, you said it perfectly. I mean, the summertime, at least in the beginning half of the summer, is very low volatility historically. Using the VIX as a proxy, it's definitely held up around that 12 level. You've seen some good support. So I think some people have questioned or wondered, well, if you look back at 2017 when the VIX was lower, 10, 11, even had some single-digit readings, they're asking, well, the markets are higher. Isn't volatility supposed to be lower when markets go higher? And why aren't we at low levels like we witnessed back in 2017? And what's really happening is, we're in new territory. And so what happens in a nutshell is there's a repricing of this volatility curve. So, I would not expect, when you get new highs, what's happening in the options market? The overriders are covering, they're scrambling, they're buying calls, they're rolling them out. So you have all these, this buying and selling that's affecting the volatility curve. And that's really holding up the volatility as we go to new highs or new territory. So, and I've said this for the last few months, don't expect to see single digits in the VIX. Expect to see a good 12 handle as support, and thus far that's been happening over the last month. But then the two things that we have right around the corner, you already mentioned it. We've got the Fed cuts right around the corner, and then the calendar is going to turn into August, and August is a more volatile period.
Yeah, we're actually seeing a little bit of a lift to that volatility today. There's a mild sell-off on the street as we're recording this, listeners. Most of the major indices off about 1/3%, if not less. And yet the market responding with a decent little premium, getting priced back into VIX cash. We were down around the 12 handle, and then it spiked over the 14 handle today, and now it's back around 1370 or so. But still fairly elevated, which, given all things else going on in the market right now, it's kind of interesting. Speaking of the cut, I'm looking at the exact numbers right now. A Fed watch at about a 77.5% for 25 basis points, and about a 22.5% for 50 basis points. It's kind of been vacillating around those levels for quite some time here. Looks like nothing changing heading into the big meeting later this week. Let's go on out to the earnings volatility front. I know, Matt, you and your team have been diligently crunching the numbers all season, and we are in it. We are in the teeth of earnings season right now. Hot and heavy time for you guys over there at ORATS. Anything surprising you maybe on the macro volatility front, or perhaps also on the earnings volatility front, sir?
On the earnings volatility, of course, this is our busy time. 6 weeks when most of the companies report. They start about 2 weeks after the quarter end and go on to the end of the next month. So we're checking each month, and I've got a new report coming out for you, Mark, that spells out each week and how many report, what to expect, how it's been going. What I'm interested in is, okay, so the first week, what happens? Okay, so you have this what expectation, and then you have what actually happens, and then how does that affect the rest of them? Do they adjust down or up? For example, first week we had 44 companies report. The actual it's slightly below what happens historically in the first week. And so now what we're seeing is people adjust those implied earnings move down a bit. So this has been fun to produce this report, and I'm going to look forward to putting it up at the Option Insider blog shortly. I'm
curious, ever since we dragged you guys kicking and screaming into producing these earnings reports, has it caused any fundamental changes on your end? Have you thought, I never thought about that before? Maybe a strategy you never considered before. Has it turned you to the dark side at all, sir?
Yeah, you know what we put almost by accident is we put where we thought volatility would fall to, and then we put we put out a results tweet too right after earnings or midway through earnings. After someone reports. Before the open or after the close, we put out where the volatility has fallen to. That's been really interesting to track, and we've actually had a few clients come to me, and since we do a good job with not only implied volatility but statistical or actual volatility, and we take volatility out of both the implied and the statistical volatility. So a lot of people are trying to get a quick handle on where volatility should fall to the day after. So I think that's been my favorite thing. That's the thing that I didn't really expect, is to watch where volatility is. I think the market makers sometimes have a tough time pinpointing where to open it up after an earnings event, especially if it's a big move. So that's been interesting to me, Mark.
Look at you driving the market now going forward. See, all those predictions, all the market making firms turning to ORATS for their post-earnings analysis. But I agree, that is one of the cooler parts. I mean, the whole report's cool, but that one kind of surprised me when you first started doing it. I was like, oh, this is actually not what I expected. I expected the straddle and the move and that stuff, but the predictions and the post-earnings event, which is, of course, where everyone wants to trade, everyone wants to be, everyone wants to get that vol crush. Usually they're trading to the dark side, and it's interesting to see you guys crunching away with that. Check them out, of course, theoptionsinsider.com. If you want more, head on over to ORATS, ORATS.com. to learn more for yourself. Speaking of learning more, Mr. Director of Risk, in the interim since our last show, something interesting arrived on my desk. I am holding it in my hands now. You too, listeners, can hold it in your hot little hands if you are so inclined as well. It's this epic investing treatise, a tome, if you will, sir, called Investing Redefined, a proven investment approach for a changing world, by some guy I never heard of, someone SWAN. But what really drew my attention was at the end here, where they mentioned the many appearances he has made on various influential investing podcasts and programs, such as The Advisor's Option. Tell me more about this book, sir, and more importantly, what's this awesome show he's referring to?
Well, I knew that would catch your eye at the end, and hopefully that isn't the only takeaway from the book. But yeah, you know what? The title kind of says it all, meaning that investing in today's world is not simply just buying stock, but using techniques and employing options to protect the portfolio so that, you know, your return distribution, at least on a risk-adjusted basis, can be beneficially altered. So in other words, you know, the book is about how can I protect my portfolio and not experience the great financial crisis while still benefiting during bull phases of the market cycle.
Yeah, good to see Randy taking some time out of his busy schedule here to put his ideas to print. But this is interesting stuff. I'm kind of going through it. And yeah, you're right. There are a lot of little kind of bullet points and takeaways. Sometimes these books, they don't really condense it well. But this one has, you know, various sections. And if you pay attention and read them, looking at it right now, crowded trades don't usually end well. That's a good little nugget. But interesting stuff here. It's called Investing Redefined. Can they find that at all the usual outlets, Chris, Amazon and everywhere else? Or is that they have to go to SWAN?
Yep, usual outlets. It's available on Amazon, and the book's kind of divided into, you know, sections like you're already looking through, right? The first part's really about the investment landscape and how that's changed, creating problems for investors and what they can do to address that. And then it talks about governance and globalization, how that's impacted investing. Goes into modern portfolio theory and the flaws of that, and then at the end really talks about the defined risk strategy and how that works and how that can be a solution for investors.
As you were speaking, I was knee-deep into the Chief Enablers, Postponing the Day of Reckoning chapter. If you like chapter headings like that, listeners, check it out, Investing Redefined by our old buddy there, Mr. Randy Swan. All right, it's summertime. That means it's time for you guys. I can't think of a better time to really dive into the office hours. We got quite the backlog of questions. Let's get to them with the summertime mailbag palooza.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is the portion of the show where you guys take the reins. You dictate where we go. You can send your questions, your comments in. You just heard how to do it. You know how to hit us up on all the various platforms. Or we actually just revamped our contact form on the Options Insider. It's brand spanking new, theoptionsinsider.com. So if you're having a hard time using it or accessing it before, we've made it front and center for you. Just go to the old form, fill it out. So you can use that now as well. We added a new option for you guys to reach out to us on this program and every other program on the old network. Let's kick it off here. Chris, I'm not the only one here who is infatuated with your title. This comes from Rayback. Rayback says, Director of Risk? ? How do I get a cool title like that? Well, clearly he has title envy here, Chris. How does he go about becoming a Director of Risk like you, sir?
So I knew you were going to start off with that one. And
how could I not?
Several answers. One of them involves some type of, only few can become Jedis, first of all. The other answer is you can name yourself whatever you want, just print up some business cards. But I think more so because I've been around a long time. I'm as old as you guys, and I've seen a lot, and I think that experience helps in risk versus reward. I'm not the same trader I was back on the floor or when I first left the floor, and been through all these different events, .com, GFC, what have you. And I think that, people who are just getting into the business haven't been through those experiences. And I'm kind of the guy to say, hey, yeah, go ahead, put that trade on, but just wait and be prepared in case these things happen. And that's kind of, how it evolved.
And it just sounds cool.
I answer better.
The Jedi one is good too. I like both of those. So there you go. Take your pick, Mr. or Mrs. Rayback there, that you become a Jedi. Or perhaps just print up some cool business cards. Either way, it does sound cool. You're right. Director. I'm glad someone else has love for that title as well. All right. Let's go to some more hardcore questions here. Got to kick it off with that one. How could I not? Kennelly wants to know. He's got two questions. Looks like they're both for you, Mr. Matt. So buckle in, strap in here. Number one. Everyone's got a variation on this question, it seems like. This is the number one question. I guess this is the dark side of creating these reports, is everyone wants to know this question from you. Number one, gun to his head, what earnings trade would Matt make? And then second part of his question, he wants to know what happened to the earnings reports, no more straddle values or move results reports. And he's right, you have updated the reports a little bit, sir. Maybe we'll start with that. Why don't you explain kind of some of the tweaks you made to the report, and then you can go about your gun-to-your-head earnings trade, sir.
Yeah, what we wanted to do was make it a little bit easier to look at, and also concentrate a little bit more on, and I'll answer the second question along with the first one, is looking at where vol might fall to, and also what historical vol is and what historical ex-earnings vols are. So it gives that not only what the earn move that's implied in the past moves, but it gets to where we're showing what the implied volatility was expected to fall to, and some historical volatilities, so you can predict where, if it falls to that, is that above or below how the stock usually moves. So, my favorite trade now is waiting for the after the announcement, which is basically a crapshoot anyway in a lot of ways, and then doing your analysis to say, okay, I'm going to be ready if this happens. This is where I think the vol should be, and these are the trades that I think we should do, Mark.
I like it. And just to clarify, are you guys are still doing the move results reports, or is that kind of baked in now? How do you guys do that?
Oh yeah, so we have the results. And we've been this is the season to tweak it a little bit during summertime. So we've got to get it out there to Gene and get it up there on your site. But we're producing the result reports. We're producing the just the regular earn move reports. And like I said, we're going to have a 6 weeks of earnings season review coming out every day now, so that'll be fun to watch too.
Every day?
Every day. We'll update it every day. Hey, earnings are coming out every day during earnings season, so we're updating it every day. You
are speaking my language, sir, and clearly you're also speaking the language of Kennelly, and I'm going out on a limb and say a lot of other people out there who are enjoying these reports. All right, we're cranking through the old mailbag backlog. We got kind of a couple of related questions here, so I'm gonna put them together. These are on the crypto front, looks like. Got it. The first one's from HFL9. He says, or perhaps she, would you rather see options on Bitcoin futures or more futures listed on more crypto products first? And then a related question from LLN saying, what products would you like to see on the Bitcoin crypto front? So I'll go first. I'll buy you guys some time to mull it over there. I'm on record since they launched the futures back in December of 2017. So a year and a half now, pretty much saying I want to see the options. I've been waiting. We actually had a good conversation about this yesterday on our Crypto Rundown program. I encourage you listeners to check it out for HFLN9 and LLN. If you're into that space, hopefully you're checking out that show, because a lot of great guests, a lot of good stuff on there. We were kind of talking about the nuances of what's really delaying the options. It seemed like everyone was gung-ho. Of course, SIBO and CME were racing each other to list the futures, and they kind of dialed it back. Literally, with the options, there's nothing. And SIBO got out of the game. And it seems like CME is leaning more towards listing more underlyings first, like an Ether future or something along those lines, rather than just listing options on the product they already have. I think, though, some of the changes we've seen recently, the futures are doing a lot more volume. And also, the rest of the volume in the crypto space has come under some pretty intense scrutiny. Upwards of 95% of it now, some people are alleging, is effectively manipulated or false. And so if you take the lion's share of that quote-unquote spot volume away, the futures, what they're doing, especially that 5X contract there at the CME, looks a lot bigger and looks a lot more impressive as a result. So that may also get the ball rolling on options. I thought we would see them already, quite frankly, but it seems like that they're leaning more towards that as well. So I would love to see. I want Bitcoin options. Then we can start adding all the other. I'm not opposed to Ether or Litecoin, whatever your flavor of the week is that you like. I'm down for it. XRP, the more the merrier, as far as I'm concerned. But I do want to see some options lists. I think that'll help accrete the volume in the futures more as well. One will feed the other. I was talking to someone yesterday on crypto, and he thought maybe it would fragment the liquidity a bit, adding the options. There's too many strikes on top of that with the futures. But I think they actually could be additive together. So let's go back around the horn to the director of risk. I know you guys haven't really jumped into the crypto fray yet with the DRS there, Chris. Maybe still evaluating. Obviously, there really aren't listed options yet, so it might be kind of hard for you guys to get in and do the size you like to do. But I'm kind of curious, do you have any thoughts here for HFL and LLN? What would you like to see happen on the Bitcoin crypto front in terms of new products, sir?
Yeah, I definitely like to see the futures a little bit more healthy with more volume. Some people said that, once they listed futures, that Bitcoin did start to trade a little differently, right? So it'd be interesting to see what happens once options do get listed, to see if that affects how the underlying is going to be traded. Because now you're going to have gamma scalpers and all these other things, and who knows how that's really going to affect this kind of product. But I think first and foremost is if we can get more volume with the futures and people can believe in that, then the next logical step is options. And yeah, being an options guy, there isn't anything I don't want to list options on. So it's just a matter of providing a healthy market that is not just a gambling mechanism, if you will. And I think that's what people may be waiting to see if, as Bitcoin matures, that it's going to provide a good investing product or a good trading vehicle that makes sense and just doesn't kind of do what it wants to do on any given day. So, because then that's going to make the product last longer, and it's not going to have it's had a quick rise, and we certainly don't want it to have a quick death as well.
That is true. Matt, it was almost a year ago you and I were on that panel down here in Chicago. I dragged you out of New Hampshire kicking and screaming to talk all things crypto derivatives. And even at that event almost a year ago, and I'm talking to Julie over there at CME, she would know, and she seemed to hint even then that they were leaning more towards more underlyings rather than options. But since you get to pick, you get to call the shots, you are king for a day here in the crypto space, at least according to these two questions here. What would you like to see next, sir, on the crypto? Or maybe it's something more esoteric. Whatever floats your boat, sir.
Well, I think it's going to be a lot of fun to see options in the skew. It seems to me it's going to look like gold. It's going to be reverse skewed. When that thing starts moving up, it really takes off. So that's going to be interesting to watch. And I think that, like Chris said, I think if you do list some options on it, you will have some effect like listing the futures. It changes the way it moves. It's we've talked a bit on your crypto show about Bitcoin and how I've been exposed to it, and I came into it kicking and screaming, and I still have a lot of let's say trepidation or worries about just the asset itself. I wish it had certain attributes. I think a lot of the people that are thinking that Bitcoin will be the panacea. You might be a little bit misguided. I'm ambivalent about Bitcoin. I feel good some days and bad other days, but I think that throwing on an option layer would make it a lot more interesting for me, Mark.
That would certainly be the case. So you're not in the market to swap some land for Bitcoin in California anymore? That's done? That's off the table?
No, I'm still open. I mean, I have Bitcoin, and I think it's definitely fungible. You could get in and get out. So unfortunately, there are some points in the market that you would be off about 9% on a couple days, but so that makes it a little bit more difficult to do a transaction. However, options might help you, hedge that transaction.
Yes, it is. I mean, what other product can you think of really that has gone from, a sub 1,000 to up to 20,000 or very near that level, and then back down to almost 3,000, and then up to about 14,000 again. And I think last I checked yesterday, it was around 10,000, or actually sub 10,000 now, 9,500. So it had all that range, all that volatility over the course of approximately 2 years, with nary an option, at least a listed option on it. There's OTC, we talk about it a lot on the crypto program, and there's overseas venues like Deribit, and they have some interesting volume over there. But in general, nothing listed, which of course is what we'd like to see. So yeah, I think we'd all be leaning on that front, and it would be fascinating to see those products. The more products, again, we're fans of products here. The more products, the merrier. The more options, pun intended, you guys have to go out to your clients, that's better for everyone. So we like that. We like that here. All right. Let's see. Next up, JL Smith wants to know, the old bugbear of OI wants to know, how important is OI, a.k.a. open interest, listeners, when you're trading options? Are there other indicators that you focus on instead? And this one comes up every now and then. Now, OI gets a lot of play in the broad options educational space. I think they imbue it with a little bit more importance than, quite frankly, it has. It's important. It's a useful thing. You should know it. But I think a lot of what OI will tell you is also reflected in other areas that are probably much more immediate to you when you're trading options, like the spread. For example, if you're on a strike that's no one's touching and no one has touched in ages, guess what? The spread's going to be pretty wide, regardless of what the OI tells you. Sometimes those indicators, they can be kind of redundant. OI also, obviously, a lagging indicator. It doesn't update but once a day, so it has some issues on that front, but it's still something you need, of course, to pay attention to. We do a lot of unusual activity analysis here, and so OI is one of the first things we turn to. We want to try to figure out what the heck is going on. Are they opening or closing? OI, a big part of that. Also, for some esoteric use cases out there, like we were talking the other day on one of our shows about the risk of assignment. Obviously, that becomes much more stark when, let's say, the OI is 1,000 and you have 900 of that. Then guess what? If there's going to be any assignment on there, you're going to have it. You're going to get a lot of it, as opposed to if there's 500,000 open on the strike, you can kind of hide in there a little bit easier. So OI comes to play in a lot of nuanced ways some people don't really understand. But in general, I don't think you need to just maximize all your trading on the strikes that have the highest OI. That's not at all what we're saying here. I think in general, things like the volume, the liquidity, that will all, and the OI will all be translated into a tighter spread. So it's a good indicator, one to watch, but also remember that it's lagging, and it shouldn't drive your strategy. You shouldn't go to a strike that just because it has a higher OI versus the one you like better. If you want to write a covered call on X strike, but you go to Y strike instead because it has a higher open interest, that isn't the way you should do it. So don't use it from that perspective. Let's go back the opposite of the way we just went. Let's go back. Let's start with Matt first. Matt, this is probably a question you guys get a lot over there because it's one of the variables you guys include in your analysis and your models, open interest. So from your perspective, how important is open interest when trading options? And also, I guess I forgot the latter part of his question, are there other indicators that you focus on instead? We could spend a whole other show on that, sir, but what are your thoughts?
Yeah, you mentioned some of the good ones. The only one I would add is the pin risk. I did a study on that a couple years back where coming into expiration, if there's a lot of open interest on a strike, the stock tends to gravitate towards it because of the gamma scalping around it. So I think that's interesting. We looked at a lot of numbers and didn't see any great strategies around there, but I also saw a few stocks that was clearly gravitating towards that high open interest strike. I like to look at it, to judge, if a big trader is opening or closing. I think that's interesting to see if they're getting out or if they're getting in, especially a big trade on a less liquid name. I like looking at just pure volume, though. We watch volume and we watch the band of expected volume, and if it gets out of that range, that's a bigger one. We look at my favorite indicator for stock direction and for volatility direction is what I call short-term contango, or it's basically the slope of the near-term expiration implied volatilities. That's what I like to look at. If it gets from contango, which is the front months are lower than the back months, to when the front months get higher than the back months, that's a little bit of a danger signal for both volatility going up and for the stock going down. So that's how I feel about open interest, and it would be great. I don't know why they couldn't update open interest. A lot of people ask me for this. If they could update open interest real time, why can't they? They can. They know what's going on. That would be a big help to, especially a lot of my clients asking for it, Mark.
Yeah, it's funny. There are two camps on that. The retail definitely want that. Some of the institutional do, but a lot of the institutional I find don't, because they don't want their their hand shown. They like having that little bit of cushion, right? They like having that day before people know what the heck they're up to. And so there's a couple. I did put that question to the CEO of the Options Clearing Corporation. They're the ones who would do it. He had an interesting answer. Check it out on our network listeners at the OIC conference recently. He didn't make it sound like it was as much of an uphill climb as I thought maybe he would push back on it a little bit more, and he didn't, which kind of surprised me. But yeah, there's a lot to unpack with open interest. I think you kind of touched on something interesting too there, Matt, which is, of course, open interest could have the other effect. It could be kind of confusing. We see this a lot for people who are new entrants to the space. They come up to an option, they look at, there's 15,000 open. This has got to be a very liquid strike. When in reality, it's one guy puts on one big trade every maybe 6 months or a year. He's overriding some calls and it happens to be that strike. And then the rest of the year, the option does like 10 contracts a day. So it's not liquid. And again, that's why the spread is important, because if you see a ton of OI, but the spread's really wide, guess what? That means just one big trade went up, but the rest of the time, nothing. And so you're kind of going to be wearing it if you put it on that product as a result. So remember, you have to take the spread into account, not just a big number on the strike. That's nice, but it doesn't tell you by all means the entire story. Mr. Director of Risk, this is probably something that comes up on your radar a lot because you're constantly choosing new strikes in terms of the puts and the calls for the different elements of the DRS that you're writing. So how important is OI to you? And also, are there other indicators that you focus on instead?
Yeah, it is something that we definitely monitor. I mean, this is a question about concentration risk. As a general rule, you certainly don't want to be the entire open interest on any one strike. So what we do is we look at strike clusters. And we look, you take a handful of strikes above and a handful of strikes below your targeted strike and just kind of get a better feel of what that open interest is for that area or that zone. Because, you may be looking at a certain strike, one strike up or one strike down, you're going to have similar vegas, similar gammas, not exactly, but very close. And as market makers or as dealers who are always trying to hedge out their book and hedge out these risks, they may not be able to do the exact same strike, but they're going to pick strikes that are similar, right? Because they're always going to want to spread themselves off. So we look at strike clusters, and you want to make sure you look at both puts and calls because of synthetics, and that can get you a little bit more comfortable with trading a certain area. Now, it also is going to depend on the underlying. Some underlyings, like spiders, you're going to have a lot of open interest. You're going to be very comfortable just about anywhere you trade. But if you trade some of these other single stock names that don't have a lot of volume and they may not have a lot of open interest, well, then it could get a little dicier on those types of products.
Yes, indeed. And there's a lot we could probably spend. It's a simple topic, yet there's many layers and nuances to it as a result. Chris mentioned another one too. If you're coming to a strike and you want to do, let's say you want to do 100 and there's 3 open and there's 3 open on every strike around it, you might be wearing that trade for a while. Just worth noting it to help you get a sense of what's going on a particular strike. How many people have played there before? That's a good indicator for if you'll be able to get out in a reasonable area. But of course, at the end of the day, I think the spread is the key. That's going to tell you the most. OI could reflect, again, just one trade versus volume and the spread. That's where you want to hang your hat for a lot of these. So much going on with OI. Let's see what questions you guys have. Let's see more related questions. People have commodity volatility on the brain. Let me just see here. There's 3 kind of related questions. Let's start off with Gorilla. Interesting spelling of Gorilla. I like it. He says, what are the AO Crew's thoughts on commodity volatility here? I'm thinking of using options to expand my client's exposure to alternatives. What are your preferred starting points? Is it as simple as buying calls, or do you prefer futures or call verticals? Let's see. And a related one here. Tim wants to know, I know you've expressed concerns about other commodity and volatility ETFs like VXX and USO. What are your thoughts on using GLD and SLV instead? My use case would be using bullish risk reversals 1 to 3 months out to maintain roughly 50 deltas of bullish exposure. And a related one here at the end here from Leonj. Are skew premiums and discounts in gold options also reflected in options on ETPs that track the products like GLD? Very informative program. Well, thank you, Leon. There are a lot of commodity volatility related questions. If you guys are writing these in, hopefully you're checking out our TWIFO program as well. This week in futures options, we get into all this good stuff there, the different volatilities, the skews, which options are lighting it up each week, which commodities are really moving and shaking. Great guests on there as well. So if you're knee deep in the commodities, check that program out. Let's see. I'll kick it off. I'll give you guys a couple couple of seconds to analyze. There's a lot of questions here. I'm going to start with the second one from Tim because I like that one. He says, you express concerns about other commodities and volatility like VXX and USO, and you are correct. We have. Those ones attempt to replicate a futures position, and they do so with varying degrees of success. They have the issues like the roll yield and the negative roll yield, really, that we've talked about many times before. It causes products like VXX to erode. We see similar issues with products like USO, and a lot of ones that just attempt to just recreate these futures positions. They do a middling job of it usually at best. That's why I do like GLD and SLV in terms because they hold the physical, so they don't have that issue. So that is probably their biggest selling point, and they do a fairly good job. Another thing, at the end of the day, you want these ETPs to track the underlying, right? And they do a fairly good job of tracking. Unlike USO, it's kind of its own beast. VXX is quite literally its own beast. So their tracking is sometimes hit or miss, often miss. But GLD and SLV do a pretty good job. It's an easy way for you to get commodity exposure in a securities account. So I'm a fan of people using those. I have no problem with that at all. And for the latter question there, are the premiums and discounts, are they reflected in the SKUs? Yes, they very much are. It's kind of analogous to what we see in the SPX versus the big ES pit at the CME. At the end of the day, there's no free lunch. If a big trades going up in the COMEX gold options there, and there's a big bid to the calls, you're going to see that reflected in the GLD call. The two pits are related. You're not going to see the calls really cheap in, let's say, July in one pit and super expensive, super bid up in the other. Because guess what? Firms will figure that out, and they will start to argue between the two of them, and they will get them both to meet somewhere there in the middle. So, yeah, it'd be nice to have these free lunch moments. Those are kind of gone. The correlations between, particularly these type of very similar products, are very tight. So yeah, you will see all of those things usually to a degree. It's not exactly identical, but to a degree reflected from one product to the other. All right, I bought you guys some time. Let's go back around the horn. I saved you for the first one too, so I didn't tread on that one for you. Let's go back the other way. Let's go back. We'll start with the director of risk, Chris. A 3-pack here of commodity volatility-oriented type questions. I know you guys have expanded the DRS to some other underlyings, and you've been analyzing these. And I know these are also hot areas with a lot of the audience of this show. The advisors out there like to get exposure to these products. So three questions here. I'll let you take them in any order you like. What are your thoughts here for Gorilla, Tim, and Leonge?
Yeah, you did a good job answering all these here. So as far as the DRS is concerned, we do have gold, so we do put the defined risk strategy on GLD currently. I do just want to add a couple of things. Like as far as a starting point is concerned, anytime you trade a new product, it doesn't matter what it is, but I'd have to say something, especially like commodities, you want to try to limited risk. I would recommend limited risk strategies first. I mean, I know here we're talking about futures and outright options with calls or verticals. I would definitely start off with verticals because commodities can run, as we've all seen. Natural gas, we know what happened in that area a few months ago. But, oil, USO, they have their runs, and right now we're in the middle of a huge gold run right now. So if you're caught on the wrong side of these big moves and you've got, unlimited risk type strategies such as just outright futures or outright calls and puts or what have you, you could get caught on the wrong side. I know long calls, long puts have limited risk, but, if you put up a lot of premium, it may seem like, you're taking a big hit, especially if you get caught on the other side of these runs. So I would kind of keep it conservative at first and just go into verticals until you learn the nuances of the product. I've said that many times on this show because even though, it's kind of, we lump equities together, but the reality is, right, all equities don't trade the same, right? Amazon isn't trading the same as a utility and or financials or what have you. And you can say the same thing about commodities. We have a tendency to lump all commodities together, but we know gold does not trade like oil and other commodities don't trade like, other commodities I have no idea about. Frozen orange juice, or I only say that because of Trading Places movie, right? But that's, again, know the nuance of your product. Be conservative when you start off. I would go with verticals first until you get to learn, how your product moves. And I think also in these, some fundamental analysis would also probably be helpful on top of the technical analysis in conjunction with your option volatility breakdown with SKUs and volatilities would help as well. Because I think, oil gold. These items, these commodities move based on larger macro type of events, what the dollar is doing, what governments are doing. And so, they're a little bit different than equities, and it is something that you need to keep an eye on. So if you're not going to watch that kind of stuff, then you definitely have to be in limited risk type strategies.
Well said, sir. And you're right. Maybe the first blush, a lot of people will be like, oh, go simple, just go for the underlying. But migrating from equities to futures is no small feat. And, there's a lot of nuances therein as well. People are used to, in the equity space, for example, buying and holding. And that's a difficult thing to replicate in the future space because you're getting marked tick to tick. And also futures have an expiration date. The equities you're used to do not. So there's a learning curve just on the underlying as well, let alone on the options side of it. So it's not quite as simple as some folks may think when they, just go to the underlying. No, it's a lot more nuanced than that. Mr. Matt, sir, I'm sure you're getting a lot more queries about the old commodity volatility there, particularly this time of year. Some people like to bring this question up. Typically, getting in the middle of summer, usually, we're kind of got a little bit of vol now, but usually it's a pretty quiet, pretty low vol environment. People are looking a little bit farther afield to get their volatility fixed. So when they come to you, Matt, invariably with these questions, and again, there's 3 of them, so take them however you like, what would you say to them, sir?
I sent you a picture of the gold skew. And you'll see.
Oh yes,
and
I do see.
Hopefully, we could put it up on your blog. But it's a pretty crazy picture. It's a skew that's moving around, sometimes even close to positive. Gold has an opposite skew of stocks, and so right around the end of May, the gold is still hovering around 120, and they came for the calls so hard that the skew went way down, and that started the rally really. So that's what I like to look at as this skew, especially in these types of momentum stocks. As Chris said, when these commodities start moving, they move one direction sometimes, and they move hard, and sometimes they'll give it away with this massive call buying that we saw. I got some GLD, I should mention, and the puts are so cheap that I just bought an in-the-money call instead of buying the physical or buying the ETF because there's just no premium on the put side. So there are things that you can do when you know that the skew is just getting so kinked towards the call side. The high strikes are going way up in implied volatility, and the low strikes are coming way down. So that's what I like to look at, Mark. And
do you have a preferred starting point? Chris likes the verticals. I think that's a very sensible starting point for people, provided they understand, obviously, the nuances of spreads and things like that. But is that the way you like people to start as well? Or maybe you think go into the futures? What are your thoughts here for, I think it was Gorilla who asked that one?
Yeah, no, I mean, like I said earlier, when I got into it, I just bought a call. It's, a few strikes down, there's no premium in it. And so you could buy a $135 asset for maybe $3, and you have protection down maybe, I don't know, $5. And so I mean that just seemed like a no brainer to me. If you're bullish on gold, that's a good way to play it.
And we will tweet out and share those charts. You can find them at Options. We'll try to include them in the show notes for you there as well, listeners. Good stuff there. You guys coming at us with all the great questions, and Matt with all the great skew data. All right, let's keep rolling. Let's squeeze a few more of you here on the old program because you're kind enough to write in, and we don't get a chance to deep dive into the mailbag as often as we would like here. Let's see. Let's go back to the equity options with Bob. Bobton wants to know, where do you think I can make the most meaningful impact to my overall portfolio with options? Through income generation, option selling, hedging, or speculative buying? Well, I say yes. Yes to all of the above. But if you listen to the show, we've outlined all those different approaches, right? They all have their uses at different times and at different scenarios. Mr. Director of Risk, I have a feeling you're going to maybe say something similar, but I won't put words in your mouth. Mr. Bobton wants to know, he apparently only wants to do one approach. So what do you have to say to him who wants to know about income generation, option selling, hedging, or speculative buying? How should he proceed, sir?
Yep, I agree with your answer, all of them. But if you want to really just focus in one, or you can find a product out there that kind of does all of these together, such as, guess what, the defined risk strategy, which we manage. But if with this question, the most important words here is the most meaningful impact to my overall portfolio. And that means the first thing that hit my head was capital preservation, right? I mean, if you really making a few nickels and dimes here selling options, okay, I don't know if that's going to be very meaningful impact. It will be income, and that's good. It's not bad. But to make a really big impact, during the large events, when the market is under a tremendous amount of stress, then I think you're really steering towards some type of hedging your portfolio, because that is what's going to preserve your capital at the end of the day. That's what's going to help you, alter that return distribution, and you'll be able to handle market stress over full market cycles.
Yeah, you're right. It's kind of 1,000 cuts of income versus, protecting against the big hit with the hedging. There's a lot of different ways to go about it. Mr. Matt, sir, what do you have to say for Bobton? I like that handle, Bobton. Income generation, option selling, hedging, or speculative buying. Those are the four buckets, the four categories he has created, sir. Which one do you want to go into?
First, hedging. Just buy a way out of the money, very small put. Don't spend very much, and just sleep a little bit better. Then, once you see that those are just going to decay, but at least they're insurance, or like life insurance, right? But once you see the decay, then you might think of, well, a little bit of income generation to pay for those. You could do buying one nearer to the money, selling two puts out of the money, 1-by-2 ratio. That brings in some money, and then it acts like you have a broken wing butterfly. So you're still flat units, or even I like to do it where I'm longer the way out of the money puts. You could generate some income, and then what I like to do is use option information to trigger myself to get out of short strategies or income producing or short gamma strategies if the market starts to look a little bit, I don't know, like volatility is coming. Looking at contango, is that getting into a dangerous area? Get out quick, and you still have your put. So that's the way I like to play it. That's the most meaningful. You got to be long, as they say at SWAN too, long and hedged, and I think that's good advice for the long term, Mark.
Well said. You got some good options there, pun intended, Bobton. You left out some interesting categories, too, some basic use cases that you could use to, I think, dramatically impact your performance. Chris hit on it earlier, capital efficiency. Using options in lieu of the underlying is a great way to go. Stock substitution, it's a simple use case, and yet it can improve your capital efficiency tremendously. Get you to use more strategies, to do more things with that capital. As a result, basic things like swapping in short puts and short calls for working limit buy and sell orders in the equities. That's another way. To just simple things. You're going to do those anyway. You're going to work those orders anyway. You might as well create an income stream out of it. And again, as long as you understand and listen to our earlier episodes about the nuances therein, that's another approach, and all sorts of ways you can use options in very, very simple, small, additive, incremental steps to keep improving the returns and improving the overall experience for your clients, as well as, of course, protecting them against those big, dark, nasty drawdowns out there. Great questions. All right, let's see. We got come up against it. Let's squeeze one more in, because we love you guys out there, and you guys love us. So it's mutual. It's a mutual love affair here on the old program. Our final question for this episode comes in from, or maybe we've got a good comment there. Maybe we'll squeeze one more after that. We'll see. A question from Mark Gregg. He says, hello. Well, hello, Mark. Nice name, by the way. He goes on to write, I've discovered this program recently and found it to be a tremendous resource for myself and my clients. Well, thank you, sir. Thank you for listening. We love you all out there. He goes on to write, I'm interested in using short call options as a way to generate additional income from a portfolio of high dividend yield equities. Is this a viable approach, or are there risks I should consider when adding an income stream to an equity where an income stream already exists? Thank you very much for this fine program. Great question. We've had different variations on this theme. This seems to be a very common, I would go as far as to say one of the most common use cases for advisors when they are using options. Advisors love income in all of its various components. A lot of them have portfolios very similar to what you're talking about here. A lot of high dividend yield stocks. Maybe they have retiree clients or things like that. So income is an important thing. Now, adding more income on top of that is a very attractive thing to a lot of advisors and their clients. But you are right to think that maybe there are some nuances there that you should consider when writing covered calls, let's say, on a high dividend paying stock. Let's go back to the director of risk, because that man, when he's not talking to us listeners, he's out there day in, day out writing them options as part of the DRS. Mr. Chris, walk our friend Mark Gregg here through some of the things he should be cognizant of if he's going to go out there and do a lot of covered calls in very high dividend yield names.
Yeah, it's a very popular strategy, certainly viable. Just in a nutshell, the three things you need to be concerned about is consistent dividend-paying stocks, which are consistent in their dividends. They're going to have a tendency to trade on lower volatility, so don't expect a ton of premium in the call. The other thing you should be aware of is that the option the short call option will already have that dividend priced into it. So again, another reason why you may not be taking in as much premium as you think. And then lastly, you'll be trading an American-style option, so you certainly need to know when you may be assigned on that short call. So those would be the three starting things I would focus on from the option side.
Mr. Matt, anything to add there, sir, on the nuances of writing covered calls in high dividend income stocks?
Yeah, we've done millions of back tests on this. It is a very popular strategy. My findings are going to be somewhat counterintuitive. It's to sell farther out of the money. So all of the things that Chris said are true. It's a lower volatility stock. The dividends are out of the calls. You're not getting much premium. So go out farther and sell the really small ones. You're still in a stock. There's still risk of it going down. Stocks tend to move, and when they move, they'll move big. You have to be there to you're taking the risk and owning the stock. Don't give away all of the upside. So my findings are buy a more out of the money or sell a more out of the money call. Maybe you have to go out a little bit farther, but you don't want to give away all of your upside because you are taking still quite a bit of risk, even though it has a dividend and you don't think it's as risky. They are. We've all seen many high dividend stocks go way down. So that's what we're finding, Mark, in our back testing.
Yeah, you said you found a lot of your back testing has found that it's the capital appreciation that really turns the tide, right? So you don't want to limit that by coming in and writing very aggressive calls, which probably would be your inclination, because as Matt mentioned, or as Chris mentioned, there really is no free lunch when these dividend-paying names. Options don't give you the dividend, so as a result, you're going to get less premium. There's less demand for those in the high dividend-paying name because people want the stock. They want to get that dividend. So you're not going to get a lot of juice for selling these things to begin with. So that's probably the first thing you should be aware of. It's not going to be a huge explosion of additional income coming your way. And then B, as Matt points out, you kind of want to get the capital appreciation. So maybe go a little bit farther out of the money, which is going to reduce your income even more. So be cognizant of that when you're going in, as well as, of course, the nuances Chris mentioned of what goes on around X dividend and your assignment risk and all that good stuff in terms of writing covered calls on a dividend paying name. That's something to be cognizant of. Got to wrap it up. I want to finish it with this one really quickly because it is kind of funny. It's a question, but it's more of a comment. I'll turn it into the family friendly version of here. But Tommaso Andretti, good Italian name, wants to know, why don't they teach this stuff on the CFA or Series 7? What the heck? This is actually useful, unlike 99% of those exams. We're with you. This show way more useful than anything you're going to learn on pretty much any of those exams out there, because none of them really teach this stuff. That's something we were talking with Eric on the last show, actually. Eric from the OIC, they have created this certificate program. And I've been on the folks at OCC and OIC for the better part of a decade now to maybe do this, to create some sort of option certification program to explain you things that are actually useful, because we know most of these exams are about regulations and things that aren't as useful for managing money. And then B, for you guys out there, the busy advisor and asset manager, you can have a little nice shingle you can hang on your wall. Say, hey, I'm certified in XYZ options. And it seemed like there was some impetus for that. And you can thank Bernie Madoff for derailing option certification for the foreseeable future. Because all of a sudden, once that happened, everyone had nightmares of certifying a guy like that. And then everyone's on the hook as a result. So yet another unintended victim, I think, of the Madoff disaster is the notion of some sort of options certification exam, which I think would be a great thing. Matt, you just recently certified yourself. Why don't they teach this stuff, as Tommaso says? Why don't they teach this stuff on the CFA or the Series 7? What the heck, sir? I blame you.
Yeah, I've taken too many tests, Mark. The CPA, CFA, level 1. And the answer is they can't. It is very complicated. With you and Chris, you're talking about 50 years of experience. So, I think what Tommaso is talking about is you're getting a lot of boots on the ground advice from ex-market makers, and we all being ex-market makers, you see a lot of things down there, and it makes you think about options and assets a lot more different. I had a lot of earnings stocks where you could just tell that people had inside knowledge about it. So you have to be, I came out of graduate school thinking, and say free market. Well, it seems like a free market, but the flow of information is held in some smaller hands and you have to be very careful about that when you're trading. So I hope what Tommaso is saying is, the things that you're learning here about, back testing millions of strategies, trading for many, many years. They're learning a lot about experience in the financial markets, not just people writing in books or writing exams. So I take that as a compliment, Mark.
There you go. We should. Gotta love the love from Tommaso. Mr. Director of Risk, the last answer is yours, sir. Why don't they teach this stuff on the CFA or the Series 7? What the heck, sir?
What the heck, huh? I do not have a CFA, but I do interact with a lot of analysts that do have the CFA. And so I did read the CFA section on options because I obviously wanted to know, okay, well, what's the thought process behind here? And when I did read that, it definitely reminded me of the whole book, right? Options, futures, and other derivatives. So it is written very theoretically. It deals a lot with pricing and not so much practical stuff. So yeah, I can totally understand where this question is coming from, and you can see it. It's the difference between theory and practical application. The theory's great, but it doesn't make me much money. It's the practical application that makes me money and money for the clients.
All right. We've gone long, listeners, but we love you guys. We have a hard time saying no when you guys are so kind as to send in questions, and you have many of them. We put a good dent in the mailbag, but there's always more to be had, and we welcome more. So if you want to join Tommaso or Leandre or Bobton or Tim or Kennelly, any of the others who wrote in today, many great ways to do it. The brands make a new contact form over there at theoptionsinsider.com. Make it nice and easy for you. Hit us up on social media. You guys like to do that too. @options is the place to go for all that good stuff. And speaking of good stuff, got a lot of good stuff coming at you here from our buddies. Let's see. Let's start off. We're just talking about this fancy book, Mr. Director of Risk. If folks want to check out the book, Investing Redefined, or perhaps they want to check out one of your 10th box events, or perhaps they want to learn more about your newsletter, what you guys have going on with the DRS, where should they go? What should they do, sir?
Well, best place is always swanglobalinvestments.com. We already mentioned where the book's available. Amazon, for sure. So in addition to the book, we do have a few new pieces out on our website. There's a series that focuses on the use of leverage, liquidity, and improper risk controls in options-based strategies.
There you go. Check it out. SwanGlobalInvestments.com, the mecca, the home for all of that content Chris just mentioned. Check it out. Good stuff there. The newsletter's got good stuff in it. Always great white papers from Mark and the rest of the team over there. So if you want some good content in between shows, I highly recommend it. Mr. Matt, folks, this is the hot time for you guys here, earnings season. But, of course, you guys do a lot more over there at Orat's Land. So if folks want to learn more, maybe they want to kick the tires on the premium earnings report, so maybe they want to schedule a little back test, where should they go? What should they do, sir?
Yeah, orats.com or Matt at orats.com. We have a new optimizer that we could run literally thousands of back tests and be able to look at all the different combination, what has worked well in the past. That's been something that I've been working on for years now. So we're very excited about that. That picture I sent over is in our development and going to be out hopefully next week, where we could show all of the history of the skew and graphs and everything. So that's a lot of fun. We also are put into our back tester all those triggers, so you could say, hey, what if I only trade gold when the trigger is really low like it is now? And it might show that that's been very positive since then. So it doesn't feel like summer. We've been working hard at ORATS, getting a lot of good feedback. So keep the questions coming. A lot of fun to be here with you and Chris, Mark.
Check it out for yourself, orats.com, ORATS.com. Give them a follow on the old Twitter as well, at OptionRats. It's an easy handle to remember. And last but certainly not least, our friend Mr. Eric over there at OIC got called away at the last minute, couldn't join us. Head on over to optionseducation.org is the place to go for a lot of great content over there, including a great section on advisors over there and what you guys can do to really arm yourself with a lot of stuff we talk about on the show. They have a lot of it there, and white papers, data, studies, all sorts of good stuff. Optionseducation.org is the place to go. And on behalf of Matt and Mr. Director of Risk, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, of course, for sending in so many great questions. We love you all. Keep those questions coming, and we'll see you back here next time for more of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.